Today we're going to talk about the recent IPO of Lyft and why I would never recommend any retail investor touch this stock with a 50-foot pole, whether that be on the long side or the short side. Now, on the short side, you're going to struggle shorting this because the supply just isn't there. But even if you were able to short it, I still wouldn't recommend it because it's just far too volatile. On the long side, the reason that I don't recommend buying Lyft, there's three main reasons. The first is they're not profitable. Now, the majority of IPOs are not profitable, so why is this such a concern when it comes to Lyft? Very simply put, I do not anticipate them to become profitable for a very, very long time. And we're going to get into a little bit more detail on why I believe that. Number two is they have no economic moat. All right, that's a term that was popularized by Warren Buffett. When I use it here, I'm actually using it in the context of the ride-sharing industry as a whole. If we go back, let's say roughly 5 years ago, and I don't know if this was the exact year, I'm just using it as an estimate. Roughly 5 years ago, the taxi industry had over 90% market share versus ride-sharing companies like Lyft and Uber. In 2019, that market share has been eroded to somewhere in the 20%. Again, I don't know exactly what it is, but the idea is there. We can also see that when it comes to the price of a New York City taxi medallion that has gone down from $1 million all the way to less than $200,000 today. That is a massive, massive, massive decline. Used to be one of the best investments you can make. And as the ride-sharing industry has taken off, the value of that has gone down as well. So there's more than enough evidence that ride-sharing has taken over taxis. And there's two main reasons for why. The first, at least in my opinion, there's two main reasons why. The first is pricing. And the second reason is convenience. These are the two main reasons that I think most people decide to use ride-sharing over taxis. However, we're going to find price under a lot, and I mean a lot of pressure over the next couple of years. We're going to get into a little bit more detail of why I believe that throughout this video. What we're not going to get into a lot of detail of is convenience. One of the biggest differentiators for Uber and Lyft is both the availability and just the app. The app is just obviously one of the things that put them on the map. In my opinion, the barrier of creating such a tool for convenience sake or even availability is something that the taxi industry can easily imitate. It's not something that's too difficult to do. The network effect is a lot harder to replicate. However, I don't tend to think of network effect as being this massive barrier. I think anybody can do it with a little bit of luck and a lot of marketing and a lot of talent when it comes to creating a product that people want to recommend to others. When I think about the ride-sharing industry as a whole, I don't think of it as this innovative industry that is completely protected from outside forces. Even if the taxi industry is not able to innovate and take some of this market share back, it could be another ride-sharing company that comes up with something different or is able to compete on one of these two axes. Or we could be some other third thing that I haven't considered yet. In addition to that, the third reason that I don't recommend going long on Lyft, and this is the biggest reason, as it is with almost everything in terms of investing, is the valuation. The valuation is completely absurd. When the IPO was first live for retail investors last week, it was trading at $87 a share at a high, roughly around there. And since then, it has come down to a price of $69 a share. I still think it's completely absurd. I would not touch this stock. I would not recommend anybody else touch this stock, like at all. At $60, I think that is too high a price. I would not buy it or recommend anybody else to buy it. At $50, the absolute maximum price that I would ever allow anybody else to ever buy Lyft without giving them shit, excuse my French, is $45. Okay, that is the absolute maximum amount that I would ever allow anybody purchase Lyft for. The main reason that that's kind of the magic number that maximum, I wouldn't touch Lyft for this price. The absolute maximum I would ever let anybody pay for it is because that brings the price to sales multiple. If you don't know what multiples are, we discussed price to earnings in the last video. You can check that out. Price to sales is the exact same thing, except obviously it uses sales instead. It brings the price to sales multiple down to roughly 6, which is much more in line with some of their comps given their growth rate. So when you factor in price to sales, you kind of have to think about the growth rate and you have to think about margins, because obviously the most important part when it comes to any business is their profitability. The idea is you want high growth and you want high margins. We're going to talk about why I suspect that, as we always find with most industries, you have to give up one of these two for the other. And I don't think it's going to look pretty for Lyft. Now, if we pull up their S1, which is the filing for the IPO where they kind of detail their business for prospective investors, you're going to find that their revenue is 2.2 billion and they're losing $1 billion on that particular revenue. Actually, excuse me, I should go down here to the net loss. So they're losing close to $1 billion on that revenue of 2.2 billion. The main reason that they're losing that money is they're spending a lot of money on sales and marketing, which is contributing to the growth of their business. So as we see that go down, we'll see margins go up, but obviously we will see the growth rate go down. And so one of the biggest stories for Lyft over the past 2 years has been the fact that they've been able to take market share from Uber. So in 2016, I believe Lyft had 21%. It might be 22. I don't remember which. They had 21% of the ride sharing industry. Since then, that has gone up to 38%. So they've gained, and the rest of it's all Uber. So they've gained the rest of that roughly 17% market share from Uber over the past 2 years. That's one of the big narratives that we've seen when it comes to the bull case for Lyft. But we're going to find over time that this sales and marketing expense is going to go down as investors pressure Lyft to become more profitable. And that's going to decrease their growth rate. It's going to decrease their market share potentially. Depends on what Uber does. If they also decrease their sales and marketing, should be interesting over time to see what happens. The bigger concern here that I've seen kind of in this S1, and it's funny, they kind of almost list this as if it's a positive. 44% of their rides start or end in low-income areas. The reason this is important is because I'm going to use an economic term for people that understand it, and then we're going to make it a little simpler. The elasticity of demand in low-income areas is obviously, they're going to be a lot more sensitive to price changes. We are going to see the prices of Lyft and Uber drives increase significantly over the next couple of years. In fact, we've already seen in this S1, unfortunately don't have this specific area, but we've seen revenue per active rider double over the last couple of years. That is a function of the fact that we've seen the pricing increase over the last couple of years. The reason we're seeing the prices go up is because the subsidies are going away and promos are going away. And when those two things go away, obviously prices are going to go up, profitability will go up, but because 44% are in low-income areas, they're a lot more likely to just no longer take rides with Lyft because it may not be affordable for them anymore. Because again, if they're in low-income areas, they're a lot more sensitive to price changes. When we look at the profitability story, usually one of the biggest things that is talked about, and let me first of all do a little bit of a definition here. Usually when we look at revenue, it's reported as gross. In this case, it's actually reported as net. And the gross number is bookings. Bookings represents the full amount of the transaction, whereas revenue represents the amount that gets sent over to Lyft. So the drivers are part of the transaction. They are not included in this revenue number, but they are included in the bookings number. One of the things you'll find discussed often when it comes to Lyft and probably Uber as well, if they decide to use this net and gross differentiation, is the take rate, which is simply the net divided by the gross. That's going to give you, I think right now, roughly 26%. And the idea is that over time, we're going to take a larger chunk of the overall transaction value as we take more from the drivers or we take more from other parties that are within the transaction. That will increase our profitability over time. There are some kind of misleading elements of this metric. For example, when it comes to bikes and scooters, the take rate in that particular area is 100%. And that is also true for a number of other things within the Lyft business. So that is one thing to keep in mind, is that take rate and the projections for take rate might be skewed a little bit by businesses like this. Right now, it's a very small one, but that might change over time. The other thing is that Lyft is struggling, or will start to struggle, I think, with more regulations when it comes to the protection of drivers on their platform. In New York City, we saw this minimum wage situation. I think it went in force in January. And we're really going to see, I think, this happen in more cities. That's going to increase the cost for Lyft. Additionally, I think insurance is going to be a major cost for Lyft over the following next couple of years. It's already a major cost now. I think that's only going to go up over time. They have a goal of an EBITDA margin. All right, so EBITDA stands for earnings before interest. That's the I, taxes, depreciation, and amortization. They have a goal of an EBITDA margin. And again, if you don't know what a margin is, it's just how much of the revenue they take into this particular metric. They have a goal of 20% by we don't know when. I really struggle to see this happening. I really do. There's too much pricing pressure when it comes to paying the drivers more, yet they seem to make it sound like they're going to be able to take more from the drivers. The thing is, when we actually look at how much, and this is Uber, but the same concept applies to Lyft as well. When we look at how much they actually get paid on an hourly basis after factoring in depreciation and gas cost, I believe this study, or one of the other studies, shows that roughly 75% of the time, when you drive for Uber or Lyft, you're not even driving people around. You're just trying to get riders in the first place. So there's a lot of wasteful time. The efficiency is quite low. That reduces your profitability, increases your depreciation, increases your gas cost, so on and so forth. The long story short here is that Lyft is going to struggle to become profitable. Even if we factor or value Lyft on a price to sales basis, they are way more expensive than their comps, which trade between roughly 5 and 7 times price to sales. And right now, I believe Lyft is at, I think, 9-ish. I'm doing kind of quick math in my head right now. So they're roughly at 9, even at $45, where they come down to a price to sales multiple, trailing multiple of 6. I still think that's too much, because I think the profitability circumstances or situation is not going to improve over time. I think the ride sharing industry as a whole is going to struggle in the long term as outside forces start to put pressure on it, especially when it comes to regulations. There is more than enough concerns here that you should not be buying Lyft right now, almost regardless. At least that's my opinion. I would love to hear yours in the comment section below. Let me know what you think. We're probably going to be talking about Uber as well when they IPO later this month, or whenever they end up doing it. I think it's going to be an interesting discussion. Probably going to be the exact same way that this one went, but we'll see. Thank you for watching. I'm back, but only for a moment. I realized when listening back to this video that I never addressed one of the biggest bull cases that's often cited for these ride-sharing companies, and that is the idea of transitioning into autonomous vehicles. If you cut the driver out of the equation, you reduce your cost, you increase your profitability, and over the long run, you will increase the value of the stock. This is all wishful thinking, and if I'm being quite frank, I think it's insane. I think it's absolutely insane to think this way. First of all, if you're talking about truly driverless vehicles, you're talking about level 5 autonomy, which has not been illustrated even in a lab environment as far as I'm aware. And even if it has been, I don't trust those results, if I'm being quite honest. It's going to take a very, 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 very long time to get level 5 autonomous vehicles onto the road. We're talking not years here, but rather decades. First of all, even we have the technology problem to solve first. Even if we solve the technology problem tomorrow, we still have to deal with all the regulations, which, by the way, there's going to be even stricter regulations when it comes to autonomous vehicles, most likely. Then we also have to deal with the fact that the insurance companies are going to have to rethink of the way that they would issue out these insurance policies for autonomous vehicles. There are so many different industries and factors and gears that have to change. This is not going to be something that happens overnight. It's not even going to be something that happens over the next couple of years. We will not be able to cut the driver out of the equation for these ride-sharing companies. Even if we have level 4 autonomous vehicles that are in simpler settings, aka urban settings where some of the paths are predetermined. First of all, if we fully predetermine some of the paths, like some of these shuttles that we've seen in some cities, they actually do have some autonomous vehicles that have predetermined paths. They can be completely driverless. They still need a safety conductor. All right, they still need a safety conductor. So in the case of a ride-sharing company, they will still need a driver, and that driver still needs to get paid, even in the case of a predetermined path. So you're going to find it's going to take a very, very, very long time for this to be a driver of profitability. And until that happens, which again, I don't expect to happen for at least 10 years, probably a lot longer, you're going to continually be paying into R&D and getting very little out of it. So your margins are going to get compressed as a result of this. Honestly, this is not a driver of profitability. And if you are investing in Lyft because of this particular scenario, or Uber, or any of these other companies, I think you're completely insane. I really do. I think this is a completely insane reason. I hate to be so blunt about it, but honestly, please do not hose yourself because of a optimistic future vision. Okay, honestly, be bullish about the idea of autonomous vehicles. Do not let your investments get affected by that vision. All right, just don't let it happen. All right, now that I've pissed a few people off, I'm going to end the video. Thank you for watching.